Okay, so this is for the subject Church Financial Management, and the topic for Chapter 6 is Managing Liquidity and Financial Position. So let's first have a review or kind of overview about liquidity and financial position. Okay, so for liquidity, again, it's the ability of an organization to have the available cash for operations, or for-profit organizations, it's the ability to convert other non-cash assets into cash. Okay, so for businesses, normally it's about selling their inventories, and then when selling their inventories or selling their services, it's either they're going to receive the revenue in cash, or it's going to be on credit in the form of receivable. So they would receive the payment at a later time, probably within 30 days or within 60 days. Okay, so if it's on credit, the sale would be would be received later, so it would be recorded as receivable. And then how much time would it take them to collect the receivables from their customers? Okay, so the length of time it takes them to convert the non-cash assets into cash, that would be the measure of their liquidity. Essentially, it's, how much cash would be available for an organization to spend for their operations. Okay, for non-profit organizations like a church, it's the same availability of cash. Okay, would be the measure of liquidity. So but in the case of churches, we don't exactly sell services or inventories or products. We don't also record pledges of contribution, but we do expect regular contributions, every week or every month from the members or the visitors during worship services. Okay. The importance of liquidity is that we can ensure smooth operations, meaning for us to be able to continue operations, conducting our activities every week, every month, regularly. So we should have the money available or the cash available to support those activities. Okay. So, for example, we needed to buy supplies for the crafts during Sunday school or chapel, or to prepare the food for the children, to pay for the jeepneys, um, or anything similar to those expenses. Okay, what would be the regular expenses of the church to operate or to conduct their activities? Okay, so the church should have enough cash on hand at any given point in time to be able to, have a smooth operations. Okay. For the measure of liquidity, normally, if we compare it to personal finance, in personal finance, a person must have at least 3 months worth of their, salaries for them to, what do you call it? To be able to afford being laid off or being fired from work, for them to transition into getting another job. So they must have at least 3 months worth of salaries, or up to 6 months worth of salaries for emergencies or contingencies, any unexpected event that may affect them financially. So for organizations, be it nonprofit or business organizations, it's the same. They must also have the same amount of cash available on hand at any given point in time. So the cash must be available, probably worth, 3 months worth of operations, up to 6 months worth of operations. They should be available at any given point in time. Okay. It would be, what do you call it? Not really problematic, but it would be concerning if the church only has enough cash on hand for, let's say, 1 month of operations or 2 weeks of operations. So, that would be concerning because you don't know if the contributions will be able to replenish the amount of cash that would allow the church to continue the activities that they have regularly. Okay, so there are different philosophies that we have with regards to liquidity, but I'm going to discuss that a bit later. So after liquidity, now that we have an understanding of liquidity, we switch to financial position. Okay. So financial position, with regards to the financial statements, we have this one, statement of financial position. Also, this is what we call the balance sheet. The inclusions or the items that would appear on the statement of financial position are the following. So you have your assets, type of assets, non-current, current and non-current. So for the current, you have your cash and cash equivalents, bills, paper money, coins, uh, bank deposits, market securities if the church engages in short-term investments. Sorry. Certificate of deposit, cash and investments, restructured for long-term purposes. These two here are non-current assets. Then you have your property and equipment, and then the other assets. Okay, so you can see the total assets or total properties owned by the church, be it long-term or short-term. And then the second part would be the liabilities or the obligations to pay of the churches. So you have accounts payable and accrued expenses, probably accrued salaries or utilities, or if they purchased something from the suppliers, let's say food supplies, art supplies, office supplies, or let's say books or computers, they bought some on credit. Okay, so they have payables. What happened? Okay, and then after the liabilities, Okay, under liabilities included also are the unearned revenue. So if um, normally these are for schools. Okay, some churches they do not separate their schools from the church operation, so they have a mixed financial statements. But in the case of GBC, BBBC is separate. Okay, but for the BBBC, they would have this unearned revenue, tuition payment of students ahead of time. Okay, so it's either they paid in full at the beginning of the trimester. Okay, so before the semester ends, normally this would have a balance. Okay, this would be earned as the services, the education is served to the students. And then you have note payable for, let's say, loans or borrowings. Okay, again, all these the church has an obligation to pay. And then we have the net assets or equity. Under these, we have the what do you call it? Contributions. Okay, net contributions. Okay, you have here without donor restrictions and then with donor restrictions. Essentially, this is the difference between assets and liabilities. Okay, and then you have the total liab and net assets. So that we call it balance sheet because the total assets must be balanced or equal amount to the total liabilities and net assets. Okay, later there would be what do you call it, ratios that would be mentioned, which would tell us if the statement if the church or the organization has a strong financial position. Okay, how much cash should be, you know, the church should have at any given point in time. Okay, how much liabilities could they, what do you call it, could they afford to be shown here, how much equity or things like that. Okay, so this would show the financial position of the church. Okay, whether they would be able to operate smoothly in the next few months, how much cash do they have available, how long, in case there is a cessation of uh, receipt of contributions. Okay, for example, there's suddenly restrictions again for people to come to church, or whatever restrictions were imposed, so there's what do you call it? Not really hindrance. There's not really a problem as well. There's an issue or there's a concern on the people being able to send their contributions. So have to make sure that you have enough cash for contingencies or to be able to still continue operating. Okay. All right. So we go back here. There's a bit of information here you can read about the recession, financial crisis that happened in 2008. Okay, the latest one is 2008. Yeah. Okay, so with regards to cash reserves, in chapter 1, we mentioned balanced budgeting versus building a cash reserve. Okay, so there are some churches who believe that balanced budgeting is a good, what do you call it? A good practice. Balanced budgeting is spending all the money that you've received for a given year. So you spend as soon as you get the money. Okay, as soon as you receive the money in the form of contributions or whatever other revenue sources it was, you have the discretion to spend it already on the different activities that the church has. Okay, so that's the philosophy of balanced budgeting. And then the other one is building a cash reserve. Okay, the reason why you try to build the cash reserve is that, again, if there are certain restrictions, the congregation would not be able to come to church or to send their contributions for a given period of time, be it short term or long term. So the church would have a reserve of cash that it may be able to use to continue its operations. Okay, so maybe to pay their workers who continue to work despite the restrictions in the conduct of certain activities or something similar to that. Okay, and then that is with regards to budgeting. There was another set of philosophy. um, First one, spend everything let God provide daily. So the, what do you call this, um, running out of money. Okay, there's a possibility that the church, the organization, would run out of money, but their philosophy is that God will provide for their needs on a daily basis. Okay, God will provide. So as soon as they have the money, they would spend it on whatever activities that they have. Maybe send it to missions. Maybe buy something for the church, something that the church needs. Okay, um, but again, the problem here is that what if the money doesn't come? But I think they have this mindset that if God doesn't provide, then we'll make do with what we have right now. But again, if you already spent it, what would you have to make do with? So there's an issue with that. But again, I think it would depend on the experience of the church or the church management or the church leaders. Okay. Of course, there's a period of time wherein I also experienced being able to receive God's blessing on a daily basis, and it's quite an awesome experience. But um there is that. For a church, I'm not sure if it would be, what do you call it, display, a show, or what do you call it, testimony of faith. That I'm not sure if, yeah, it might be a question of faith as well. Okay, because if they have a stronger faith that God would really provide on a daily basis, and then of course we do things differently. So if it works for them, good for them, right? But contingencies for our usual organizations, what we normally do is we try to build a cash reserve for contingencies. That's the other philosophy. Okay, prepare for the future. In a way, both philosophies have what do you call it, passages in the Bible that would support both philosophies. So yeah, it's only a matter of what the church leaders believe in that particular idea. Are you going to let God provide on a daily basis and spend what you have, or are you going to build a cash reserve that would help you tide over a difficult period of time, just in case, okay? Um, just in case something happens, okay? So those are the two philosophies. The other one for organizations. Okay, so in personal finance, it's 3 to 6 months worth of revenue or of salaries. For organizations, it's 25 to 50% of their annual cash revenue. So in a way, it's also 3 to 6 months worth of their total income. Okay. So process. Oh, sorry. Alright, so that would be it for the first video about the spending philosophy. And in the next video, we would discuss about debt philosophy and then maybe investment management as well. Okay, so I'll stop this here and then continue a little bit later.